And we are live today. I'm very happy to welcome Liscivia. Hopefully, I'm saying it right.
Yeah, absolutely, sir.
Okay, that's perfect. Very happy to have you here. We're going to talk a lot about liquidity, macroeconomy, why Bitcoin price is going up, why Bitcoin price is going down. Is there any correlation out there? And yeah, I'm
Awesome.
very happy to have you on the podcast. And yeah,
Thank you, sir. Likewise, it's a pleasure.
first, I'm gonna start by presenting the arch. Oh, Clement's here. Hi, hi, bro.
Hello, everyone.
Hello
You are
there.
live. You are live. Are you staying with us, Clement? Ah, we already lost him.
Yes. I don't know if it's you or if my network is probably really bad. So
I think it's yours, bro. I think it's yours. Okay, I'm kicking you out.
yeah, sorry.
Ah,
See
Yeah.
you. Now
Sure,
you
guys.
good?
Bye bye.
bye, sir.
Yeah. See you, Clement. I kick you out of the stream. Yep. So I'm gonna briefly present the arch. And yeah, so what is the Arch? The Arch is an association of Web3 builders, and we aim to help each other on different verticals. So we help each other for recruitment. We have a database for that. We help each other on social networks. We like each other posts and do all those social stuff. And we also do live show with great entrepreneurs or great researcher like today. And yeah, so we are generally doing like two live stream per week. And yeah, as I said today, I'm very happy to be with Liscivia. I'm gonna share his Twitter if you guys want to follow him.
Thank you.
And yeah, your turn, my friend. Who are you, and how did you get into crypto in the first place?
Okay, so I am an Italian guy. I live in the northern part of Italy, and I got into crypto in 2016.
Okay,
I was really captivated by the ethos of the space, and it resonated with me. I come from a different background, and actually, crypto is what introduced me into finance.
okay,
Uh,
very cool.
so I got really passionate about it, um, and I also started studying programming when I first started to uh, actually right after I started mining Ethereum in 2016. So these days,
You bought
I'm
you
more
bought
into.
Ethereum in 2016? Sorry, I didn't hear what you
Yeah,
said. Yeah.
yeah, I did. I did. It was a great financial decision, I can say.
Good job.
Yeah. Yeah, I was molto bene, sir. Um, I was yeah, I was captivated by the talks of Vitalik Buterin at the
Okay.
DAFCON of that year, and I really did an approach to the space because of speculation or because I wanted to necessarily make money. It was just more I was fascinated by the idea of the financial infrastructure of tomorrow to come to fruition through this vision of uh, of Ethereum, of a better of a network that would be inclusive of more people, and to give better rights to everyone to get the access to financial instruments, and so that is how things started for me. And since then, yeah, I studied a lot. I got involved in the space directly, and I've been studying a lot macroeconomics, finance, and programming. Like I said, these days I do data analysis uh, in my day to day, and yeah, I worked on this platform called Liquidity, which we pushed just recently.
We
Obviously,
will
we
talk.
still have,
Yeah,
yeah,
yeah, yeah. We will have plenty of time to talk about liquidity risk,
yeah.
a platform I love, by the way. But before, I want to understand a bit more your mindset. Like, okay, you said you discovered Bitcoin, crypto, let's say in 2016. You bought ETH this year, but what brings you to crypto at this space? Okay, I know you like the ethos, but who talked to you about it? How did you discover it? Because at that time, that was not that mainstream, you know.
The first time that I heard about Bitcoin and Ethereum was actually because um, I was introduced by it by a friend of mine, which was studying computer programming at the time,
Okay,
and yeah, the in fact the first idea was to mine those coins, uh, which we which we ended up doing afterwards together.
okay,
We formed a small team, and we pulled some capital, and we bought our first mining rigs. We put them together with GPUs, and
oh, cool.
yeah, from there, well, obviously, then the whole ICO bubble from 2016 exploded right onto our faces, basically. Yeah, it's been a crazy year at a time, and yeah, we got involved with we saw basically DeFi being born, and it was quite exciting, honestly, because I've always been like a visionary, and I've always believed in this. Like I said, I resonated with the ethos, so um, I immediately started investing in projects that were um, you know decentralized exchanges. I remember the first one was meant to be Omisego at a time,
Oh
which
yeah, Mr.
uh,
Go, yeah,
yeah, afterwards it ended up becoming like sort of a layer two wannabe layer two solution
yeah,
as it pivoted there. But I immediately like fell in love with the idea of decentralizing finance,
yeah.
um, and that is my main also in my investing. If you want to ask me about my mindset, that is my main area of interest because I believe that the infrastructure um, for the financial instruments of the future lies there. It is going to be is going to obviously everything is probably going to run on blockchain, and today is not like a big thing, to say this, but in 2016 it was very uncertain, and
Agree. And
yeah.
what do you think about privacy? Because okay, everything can be decentralized, but then everything is public. And I mean, today at the time when we were all the cypherpunk and nobody cares, nobody were looking at the blockchain, but
Yeah.
now everyone is getting an eye on it. I mean, yeah. So is it
Yeah.
also part of your investment thesis? And
Yeah. I don't know if it. I actually have some allocation into some privacy coins, but yeah, in terms of the value that privacy has, um, I definitely like you can see I'm an anon, and it's not like I got anything to hide, but I believe that especially with the advent of the AI, this theme of privacy will become like more and more important, and it
okay,
should be considered one of the basic human rights, not because you have something to hide, but just because your data has value, and since you are a consumer that produces data, um, and you also make financial transactions that could be mm, could represent a problem, like for instance, maybe with your employer for whatever reason. Um, you know, I believe that, like I said, it should be considered a basic human right. I'm afraid that in the next like decade or so, the push to centralization and control will be such that these themes will become way more relevant than they are now, especially if CBDCs, see the light.
Agree,
And
agree. Did you
yeah,
did you hear about Christine Lagarde trap? Like she was trapped by Russian hackers who pretended to be Zelensky or whoever in the Ukrainian government, and they called her, and she basically said on their, let's say, podcast, I don't know, she literally said, yeah, in the last event in France, in the last terrorist attack, they managed to finance this attack with very few amount, like 30 euros, 50 euros, with mobile money card and stuff like that. So we need to control even the smaller amount and stuff like that. And
yeah,
she admitted, like, with European CBDCs, that they will be able to control even very tiny amount, like 30 was 50 or 100 bucks. It's, yeah, I don't know if you showed
yeah.
this video, but what do you think about it?
Yeah, I think that every time that some of the basic rights that people have are taken from them, there's always like a very reasonable and very, uh, a very reasonable motivation for doing that, for taking away some of your freedom. But oftentimes that represents mostly like a scapegoat. And so I believe that there should the problem now that is that with politics the control is so distant from the populations that you don't really have a say unless you express your right to be through, I believe, through technology these days. Because what blockchain allows people to do is to design a better world and to put in place rules that are not going to be able to be manipulated from the powers that be. And you know, um, like I said, I think that the push to control is going to be bigger and bigger as technology allows it. I think that people should fight back with technology in the same way, from the bottom up. And yeah, CBDCs are just like the perfect picture of this. Um, it's it's definitely something that's going to happen, and I believe that um, it's going to be like they say in markets, that is good.
I
That
think it's gonna be the Trojan horse,
yeah,
of crypto. Like there is the CBDC and
I
USDC.
agree.
Like we have two Trojan horses there, and
Yeah, yeah,
yeah,
I agree. I agree because, like I said, that is good. The public opinion has to mature in terms of um, the utilization and the trust of code, or the mistrust of the intermediary um, that is gonna um, push this kind of
yeah.
attempts of controlling you. So. Um, yeah, of course, I believe that uh, you know fiscal this kind of fiscal pressure. Obviously, I live in Italy. Is one of the highest of the places with the highest fiscal pressure uh, in Europe,
In the
and
world, you can say.
in the world. Yeah,
Yeah,
and also in the world. So obviously, when the state is is um, is watching each and every transaction of yours, and it's not good for people. And I think that, they shouldn't necessarily fight back with with illegal means, but um, I think that crypto and blockchain technology are means to um, eventually defend the rights of people.
Yeah. The first good thing about Bitcoin is like states cannot take them from you, except if you store your private key into your PC and they access to it. But but I
Yeah,
mean,
that's the first time that you actually have property right that is encoded,
yeah,
uh,
that's
and that
crazy.
means a lot. Yeah,
Yeah,
that means a lot. And also, I cannot wait for the time when people will be able to transact between each other and in crypto, in whatever currency they will prefer, and that will mean a lot for the state economy, because immediately the government will have to be much more responsible about their spending, about their uh,
yeah,
about their expenses, about their management of public resources, and that's going to be ultimately a good thing, I believe.
yeah. 100% agree with you. And it's so funny. Like governments, they want us to be 100% transparent, show everything we have, but when it matters, the money, the taxes, we give it to them, it's 100% black, black screen. We cannot see what they are doing with the money we give
Exactly.
them on a daily basis. And they ask us to be transparent and pretexting we're going to be under terrorist attack and stuff like that. And this is for good to protect us. But at the end of the day, I would like the opposite. Like, be transparent with the money we give you to manage the country. What are you really doing with this money? Can we get roads? Can we get hospital? Can we get other public infrastructure? Or is everything going to corrupted private companies, financial stuff? And we noticed that like during the COVID crisis, they start printed a lot of money, and I think it's a good way to switch to the macroeconomical point. And I will
Yeah.
give you back the word here. So yeah,
Yeah, it should be, to answer to this last topic. It should at least go both ways, and I think that blockchain technology will eventually be what brings this kind of transparency in, and in the public sphere. But yeah, talking about what governments have done in the last years with quantitative easing and stimulating the economy.
yeah.
That's been
Can you briefly explain to our audience what is quantitative easing? I'm sure it's a
yeah.
complex.
Yeah, no, it's not that complex. It's just it's the act of inflating the money supply, and in particular the banking sector reserves, through the act of purchasing uh, bonds or treasury securities, uh, public debt, uh, practically, from the open markets. And that goes for quantitative easing. While quantitative tightening, it should be meant to do the exact opposite thing, except except the fact that central banks are pretty good at expanding the money supply in times of need of economic stimulus, while if they have to tighten the economic conditions and raise the price of money, that in a debt-based economy doesn't work really well. And so, for example, right now we're undergoing quantitative tightening, which is the process that depletes reserves from the banking sector, and that that should work in reverse, as I said, and
Okay,
the balance sheet of the central bank should be depleted of these assets by the act of them selling these assets. But that's not actually what is happening right now. They're just letting the bonds roll off from their balance sheet to just be much more delicate in this process, because they know that a debt-based economy is a leveraged system, and it doesn't work well with deflation, and it becomes very delicate once you start to withdraw liquidity from it. And yeah, at the end of the day, this quantitative easing and quantitative tightening process is a process of managing the liquidity in the system. And that ultimately is what affects market cycles
Okay,
in a
so
big way.
basically you are saying, like, I try to resume what you say. You are saying that the money in circulation, the liquidity, the money in circulation has big impact on
Yeah,
the market, and whether it's
yeah,
crypto or not, and what's happening out there.
yeah.
So, so yeah, let's dive into what happened with COVID. What have they done? What are the consequences of that? And where we are now.
Yeah,
And
maybe I can show you. I can show
yeah,
you some charts about that.
yeah,
Which,
I'm sharing your screen now.
okay, awesome. This is our platform.
So
Um,
yeah, people can see what they can also see your platform. So can you briefly explain to us what is liquidity with, and then we will continue.
yeah, we created this platform that is meant to ease the process of understanding liquidity conditions, and yeah, make people able to check what is the current status of the liquidity flows in the markets. So we created a few panels. We started with the U.S., which is obviously the most important economy in the world. We're soon gonna add China, and we have some another panel for global liquidity conditions, and we also plan to dive further. We also have some charts for stablecoin liquidity in crypto, which we plan to expand with more on-chain data. But for the moment, we look mostly at funding liquidity, which is the type of liquidity that basically collateralizes the debt economy. So in this chart, you can see the reserve balances of the banking sector. And like we were saying, here you have the COVID crash.
So what are the reserve balance? Sorry for asking very simple question for you, but
Yeah,
like the goal of this talk is also to explain to a larger audience what's happening.
yeah, absolutely. So in red, you can basically see what are the reserves of the banking sector. So these, you know, a typical bank has a balance sheet through which it manages their assets and their liabilities. So the money that you deposit in a bank can be viewed as a liability of the bank, while loans uh, that the bank offers to their customers, and um, bonds and securities can be considered assets. And these reserves can also be considered assets. They are typically deposited at the Federal Reserve, that pays an interest to the bank that deposits these reserves. And these are basically this is the capital that allows withdrawals from banks. Okay, so this is what makes this is the cash that it's in the bank's balance sheet that makes them solvent to a certain degree.
Nice.
So you
For
can see
this,
it changes throughout the years, and at the moment we we are in a so-called ample reserves regime. So since 2000, the great financial crisis in 2008, um, the banking sector was basically flooded with liquidity to guarantee solvency and to prevent liquidity issues. And this is basically what happened also with the COVID crash. As you can see, like a slight liquidity withdrawal happened before it, and it was like preceding the event. And in the moment when the conditions were the worst, the central banks injected a lot of liquidity. We are looking at the U.S. liquidity condition at the moment, so we're talking about the Fed specifically. But this enormous injection of liquidity was also very inflationary on the supply of public money, because there is this distinction between the reserves of the banking sector and the money that freely circulates in the economy. As you can see, in the years that followed this event, the markets started to move in tandem in correlation with this, with a change in these reserves. Here we went through a massive liquidity injection, and the markets basically followed. And here is when they started to withdraw liquidity with quantitative tightening from the reserves. And as you can see, the markets adapted. These days, you can see that here we have like a big spike these days. Maybe later we can talk about what this means and what's happening right now.
First, I have a question regarding the years 2018 to 20. Like, this is the exact opposite. Like the reserves are going down, but the stock market, the S&P 500 is going up. Like, how can you explain this?
Basically, your question is before the COVID crash.
Yeah.
Yeah, actually, while there's not, let's say, I can explain maybe this better looking at this chart, because what you see here is this almost perfect correlation between this green area and the S&P 500.
Okay.
This is what we call net liquidity, and what is considered to sustain asset prices at the moment. But honestly, the fact is that when you consider the whole balance sheet of the Federal Reserve, those assets that are inside that balance sheet are basically bought with QE, as we said. Obviously, the reason why prices follow liquidity once, say, the injection is big enough, is because the wealth effect that is produced when those bonds are acquired by the Federal Reserve with QE obviously enters in the social pyramid, and inflates the holdings of the biggest asset owners, so the richest people in the world. They are obviously, being the biggest asset owners, they will hold equities, and this is why they will probably have an interest in bidding up, for example, the S&P 500. You can see this since the COVID crash, because the liquidity injected has been just too much. And before that, there was a slight liquidity withdrawal, but there was no real, the trend in the market was not, was not questioned. And we went through, really a long time with very low interest rates, and that also impacts the valuation of equity and risk assets. So there was it was just the way I interpret this drop in liquidity, while the assets basically didn't follow, is just trust. But you can see that while liquidity is abundant, the trend is much more stable. And then when liquidity starts to get drawn from the system, then you have the first crashes, and eventually you have, problems. Obviously, here there were a lot of, we should say, synchronicities, but I believe that a crisis was due since we entered the negative interest rates regime,
Yeah.
which economically doesn't make a
Any
lot of
sense?
sense.
Yeah.
Yes, and well, maybe, but there's also this white line, which was basically the target of the quantitative tightening policy declared from the Fed, which set at $2.6 trillion. Seems like we rebounded pretty hard from 3 trillions, so maybe they misjudged. Actually, we went as low as 2.8 trillions, and then we rebounded from there. So this was my target for quantitative tightening, and we went pretty close to that. But yeah, right now the big thing is the BTFT program. The difference between this big spike in this chart versus this one, in which we removed those newly added assets to the balance sheet. That's a big topic today with the banking crisis. But yeah, I think I hope I answered a lot of your questions about reserve balances.
That's perfect. Yeah. Before we continue, maybe can you tell us where does your data come from? Why is this
Yeah,
data public or private? How do you get it? Like I can see you want to do China liquidity. Do we
yeah,
have a lot of data on China liquidity? I doubt it. Yeah. Tell us where do you find it?
yeah. Yeah, we basically gather the data from all the official resources, so central banks around the globe, the Treasury of the United States. Well, obviously for our crypto charts, we source it directly from the blockchain. So we go straight to the source. The problem that we saw with a lot of economical data is that is often pretty gated. For instance, um, like this data on liquidity is available live on Bloomberg. They had it like for a while. Actually, it's not as updated as ours because ours comes in daily and theirs comes in weekly. But yeah, it's kind of cool that we were able to do a better job. But yeah, yeah. But for example, you mentioned China, and China is the perfect example. It's very difficult to gather data, reliable data on um, yeah on some of the legacy institutions of finance, because there's a lot of pockets in the financial sector that are kind of shadowy with their operations. Surely China is to a certain degree. The U.S. sector is definitely more open and more transparent, but you don't always have the data that you would need, and it's often very expensive, very expensive. So we're trying to lower the bar in that sense and work towards providing the most useful data for people to interpret this liquidity flows in markets, and to get basically policy and macro trends right.
Nice. So I have a few questions. First, why is your data uh, actualized on a daily basis and
Yeah,
Bloomberg it's like every week? Like how do
yeah.
you manage to beat those guys?
How does that work? Yeah, basically, the fact is that Bloomberg takes data from the Federal Reserve of St. Louis, I believe, or from the Federal Reserve in New York, the branches. But for in regards of the TGA data, which is the data that comes from the Treasury of the United States, we look at the daily Treasury statement directly from the Treasury. So that's something that they don't do, and that allows us to give this data daily. And this is actually, I believe, this is the same model that Morgan Stanley uses to grasp the liquidity status of the U.S. markets. And not that we heard it from them, but it's useful because if you have daily daily data points, obviously the model is more responsive. So yeah, what can I say? Bloomberg obviously has like a 1,000 more indicators. We're certainly the underdogs here, but in terms of this very specific niche, I think that we can defend ourselves.
Nice, that's very cool. And so those data as given to us by our dear governments, how much can we trust them? How much can we trust this data that the government is giving us? And how far is this data from M2? You know, the money in
Okay.
M0, M1, M2, like how it
Yeah, what is the difference? Maybe we should show that too. Like for example,
and my
on this
first
chart.
question was, do you trust those data given by the US government? How much?
Yeah, oh, yeah. I think the data that comes from the U.S. is pretty high quality, and it's reliable.
Okay,
I think that it's reliable in most cases. You there certainly are some kind of some kind of edge cases here and there. Wink, wink, China. But yeah, in terms of the relationship between different types of liquidity, mm, this is a nice way to introduce the topic of um, the fact that liquidity is a slightly complicated subject, and it can be looked from many different angles. And you have many different pockets of liquidity throughout the financial system, which comprise central banks liquidity, which comprise the banking sector's liquidity and reserves, the public money available in the economy, so M2. You got credit, which is another interesting measure to understand how much of this liquidity is basically lent into existence. You got a lot of angles, like I said. The relationship, is there. There's some macroeconomists that put some very very hard brackets and very defined distinctions between all these pockets of liquidity. But I believe that eventually, especially when the liquidity is enough and the size is big enough, liquidity tends to slip from one pocket to the other, let's say, or from one bucket into the other, we should say. And the M2 liquidity is the liquidity that is in the hands of the public sector. It's the liquidity that you have deposited in your bank account, is the money that you use, that it's in your wallet, and it's all the cash that it's readily available to be withdrawn and used by the general public and retail investors in the economy. This measure of liquidity is impacted by many factors, such as such as the issuance and the purchase of public debt by the banking sector and from the governments. It's impacted by credit, obviously. Um, and it's impacted by interest rates, and because it's basically money on leverage. One thing that it's like a basic concept is that borrowing money creates new money, and prints, for lack of a better term, new money into existence. There's definitely a correlation with the public money and net liquidity, and banking sector's liquidity and central banks liquidity altogether, and credit also. It's all interrelated. Here you basically have, like in purple, this slightly lighter purple line at the top is the total amount of assets present in the Federal Reserve's balance sheet. So if you go to compare the sizes of liquidity in the markets, you can see the money supply here is like more than it should be around 100 trillion dollars globally. This is M2. While if you look at the liquidity inside the balance sheet of the banking sector, you have like quantitatively it's less. It's roughly $30 trillion of assets. But qualitatively, this is very important because it leads the pack. So the assets that are purchased through quantitative easing by central banks create this wealth effect that, as I was explaining, inflates the price of these treasury securities and creates wealth in the economy, especially from the top of the pyramid down into the bottom. So since the top holders of assets, as we explained at the beginning of the conversation, those people have an interest and have a track record of bidding up the price of valuable assets in the economy. So housing, equities, which is basically cash flow, and pension. That is described as asset inflation, and this process of QE, of inflating this supply of the assets in the central bank balance sheet, creates wealth for that category of market participants that eventually inflate the price of valuable goods. Because if you think about money as basically as the unit of account through which you measure value, obviously when there's more of that floating around, you will use more of those units to price valuable goods. In particular, in this chart, we also have like a subtraction from the total amount of assets held at the Federal Reserve, and we subtracted the TGA in purple and the RRP, which are the Treasury General Account of the United States, which is basically the bank account of the United States held at the Federal Reserve, and the repo market from the total amount of assets bought with QE and present in the balance sheet.
What is the repo market? Sorry, what is the repo market?
The repo market is basically it's a short-term lending market in which there's basically two counterparties: lenders of cash and borrowers of cash. And basically borrowers, it's a secured market, meaning that each transaction which is typically an overnight or very short-term transaction. Each transaction is secured by a treasury security, like a bond, for example, or a T-bill. So the borrowers collateralize their securities as asset to secure the transaction, and the lenders, which lend the cash, get paid in an interest rate. They get paid an interest rate, which is called SOFR, from Secured Overnight Financing Rate, if the deal is conducted between two regular counterparties. But if the deal is conducted with the Fed, it's called the award rate, which is another chart that we have here. This is basically the size of the repo market and how it grew from basically a few years ago in 2000. This was 2020, I believe, 21. But yeah, it's the repo market has been thought of as basically a way to withdraw excess liquidity produced with QE from the markets and to aid the Federal Reserve in their policy. And but today this is becoming more of a problem.
Yeah, a few questions on that. So this repo market, like lender and borrowers, we are talking mostly about banks, right? Or do you have companies or stuff like that? Lender and borrowers on the repo market are mostly banks, right?
There's mostly money markets and hedge funds, but there's also, it's a very decentralized market. So there's a lot of participants in this market, and yeah.
And what happened when the collateral you use to borrow money is a poor collateral or is overvalued? I don't know. Let's say like you used CDS from the 2008-2009 crisis as collateral to borrow money. Like, what are the risks? What could happen?
In terms of the repo market, the main collateral used are securities, and there's specific types of securities that are more or less in demand to collateralize repo transactions. Typically, CDS are not this type of collateral used in the repo, but the fact that repo transactions are quite secure is not the real issue here. I believe that repo market participants are pretty happy, mostly with the yield that they're getting from this type of transaction. Problem here is the banking sector, because this is withdrawing liquidity from what was produced with QE, because all the money inside the repo. The reason why in this chart the repo is deducted from the equation, as is the TGA, is because the money inside these two pockets, let's say, of the financial system doesn't bid up equities. Obviously, the Treasury General account, you can it's pretty simple to imagine why it doesn't buy the S&P 500 or Bitcoin. But for the repo market, the money is locked in these deals. The participants are generally quite happy, as I said, and the problems are banks and the bank's business model, because as you may know these days, there's a liquidity crisis going on with the banking sector. And obviously we can talk about the bank term funding program and the fact that a lot of there were some banks that were having like very risky management of their bonds portfolios, and that exacerbated and started this crisis. But basically the whole business model of a bank is being questioned here, and it's undergoing a lot of stress, and it's due to this it's also due to the yields that the treasuries are providing and that the repo market also provides, mainly, as I said, to money markets, which are these other financial institutions, often referred to as participants in the shadow banking sector. And the first thing is that they provide better guarantees on the deposits of their customers. And so when you have this threshold of $200,000 or even lower in the EU, the first thing is security, and trust. So the perception of the general public, it becomes fear very quickly, and so it exacerbates these runs that we had recently, and these failures eventually. But in terms of the business model of the bank, also there's this fact that with policy and with securities having grown so much in the yield that they provide to investors, and the repo award rate, which is basically the floor for all the yields inside the repo market too. All these rates have grown tremendously, and they challenge, the deposit rate of banks, which is still close to zero. So, in fact, liquidity has been leaving banks for a while now. And even before this banking crisis started, liquidity has been leaving basically bank reserves, and has been growing inside this repo market and in money market funds. And this is a problem because, as we explained in the reserve balances chart, the target of quantitative tightening is reducing reserves up until inflation subsides, theoretically. So we have inflation that is trending down at the moment, but probably the Fed was of the opinion that there may have been a rebound, and they wanted to push the higher for longer narrative and policy. But at this point, with the banking sector undergoing this type of stress, the market, as I said, we have this bank term funding program inflating the assets in the balance sheet of the Federal Reserve, even if those assets are not bought with QE. So we made a distinction there, and we are soon going to implement like a switch to allow people to freely select between our charts. The model with that accounts for those assets to that are kind of fake QE or are not QE. But where was I at? I'm losing myself. The fact is that reserve balances with the banking sector, reserve balances were meant to be withdrawn up until inflation were to subside. But as the banking sector basically caused the Fed to intervene in emergency, so in such a size and with such rush, that puts Jerome Powell in a very difficult spot. And we believe with the last FOMC meeting, we've really seen like a shift in the tone of the guy. So I'm starting to shift myself and this doesn't mean that a recession is incoming. This doesn't necessarily mean that we've already seen the bottom, but I think that the pivoting point for the U.S. monetary policy becomes closer since we see that the balances of the banking sector are starting to clearly tell us that um, the um, the the minimum threshold, the ceiling has been hit.
Okay.
I believe this is very important to for all investors to get and to get your investment decisions right.
Yeah. So, what would be the consequences? Like people trying to solve their assets and testing the reserve balance of each bank, and and then more people selling, more people will have to accept their loss and sell lower, 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 lower until the Fed intervene, or what would be the scenario?
Oh, okay, yeah. At the beginning of the conversation, I said that a deflationary system, um, I'm sorry, an inflationary system uh, that that is basically the debt economy that works on leverage doesn't work well with deflation, and what you get eventually is a liquidation cascade if they're stubborn enough to push the financial system into this, um, to push it underwater. Because what basically created the the conditions for the banking sector to experience this level of pain was policy. Um, and what I recently did a thread, a Twitter thread about this, and what I believe it could be. It could be the scenario that in my mind is likely. Obviously, this is my speculation, and it's really difficult to predict the future. But what I believe is that the politics and central banking are obviously they have a conflict of interest in letting a very serious liquidation cascade happen,
Yeah,
and I believe that the you know credit risk is basically non-existent in a system where basically the you can print money to guarantee solvency. So what I believe
but it
that
cannot. I mean, it has to end at some point, no? Like you cannot print money forever. Like you are causing a lot of inflation, as you said, inside the country.
yeah,
Like, what is the limit to printing money? When does it stop?
I think that definitely Max Payne is up only to speak with a crypto native language. So um, yeah, I don't really think. I think that eventually, if we have to look far into the future, which is, like I said, it's difficult to predict, but I think that CBDCs will be a means to basically um,
Print more?
to switch no but to control a monetary supply that is escaping logarithmically the the control of what would be considered sustainable in the economy, because in the near term, I think that um, if the Fed keeps withdrawing liquidity from the system, and I think in the medium term this is unlikely. They will eventually cause some serious liquidation events, like I said, and if that happens, if that kind of stress is pushed into markets, they will have to intervene. It will be necessary, and you will see, just like it's happening now. It's just if you look at what it's already happening, um, and um, and they will have to inject liquidity in the system to basically to let it work again. And so
Okay, so you think it's imminent? You are thinking like it's imminent, and
I think that the fact is that they wanted to push policy, and everyone until inflation subsided. But I think that inflation can be sticky for many reasons that are not necessarily linked to monetary inflation, even though monetary inflation plays a big part. But in the long run, if you have such a leveraged economy that cannot withstand liquidity withdrawal for too long, you will tighten economic condition until you break something, as everyone was saying. And I believe that it's pretty evident that they did break something. And even though the crisis may subside, even though it is this is a measure of the stress of the banking sector, and you can see the level of utilization of this emergency funding program that they instituted to bail out banks. So even if this subsides and the levels drop, this is probably just one of the first signs of what is next to come. So, and the only thing to intervene in this case is producing liquidity. The fact that it is not considered QE in the BTFP case, just because there's no direct asset purchase, this doesn't mean that eventually that liquidity, once it becomes enough in size, will not, as I said, slip into other areas of the economy. If only just because banks will have to find a way to keep being profitable. After all, they're businesses, and if they borrow this liquidity at, say, 5%, they will have to find a better yield to justify that expense. And eventually, this is the way this liquidity injections they slip into maybe the housing market through the purchase of mortgage-backed securities, or into basically down into the risk curve. I think that liquidity injections are the way that central banks take care of basically keeping the financial system flowing, working. And as you can see here in this chart, you can see basically the liquidity injections on an assets change basis in response to, for example, the COVID crash here on April of 2020. And this is the massive surge that we had in central bank assets, and this is the massive surge in risk and equity that we had afterwards. So in the long run, I believe that liquidity has to be injected in the system, in a system that is undergoing stress. This system is inflationary in nature, and every time that you try to withdraw too much liquidity from it, eventually you end up with very serious problems in the financial sector that gradually get transmitted into the real economy. And once the pain is felt in the real economy, you get such a Lunghurst, and the inequality becoming larger through rich and poor people, and that kind of political pressure forces even more stimulus and intervention. So this is the nature of the beast, And this is why following liquidity dynamics is important to understand how markets move, because basically it's those dynamics that you know lead the way in terms of pricing risk.
Okay, very well. And I'm a user of your product. I like it. I think it's very interesting to have all this data,
Okay.
which are in real time, like pretty much.
Yeah.
The channel I use the most is the oscillator.
Oh, the oscillator.
Yeah.
Yeah, that's another chart that we're gonna soon update with the switch that I was talking about.
Okay.
You see, since the COVID crash, the injection of liquidity has been so big that markets became really correlated with it. And here you have a delta, which is expressed in this orange oscillator between the price of the U.S. equity markets and the S&P, uh, and the green is the net U.S. liquidity, so the liquidity condition of the U.S. Um, Recently, you see there's quite the turbulence in the indicator, and it's probably due uh, to the fact that we have subtracted this. We believe that the most you know, conservative decision was to subtract these assets that were inflating the. Maybe we should take a step back and describe what this bank term funding program is eventually. But there's two ways to interpret this chart recently, and one is a chart that includes these new assets that were added to the Fed's balance sheet through the BTFP program. And one is the actual chart that you see right here, which is just the assets that were purchased with QE. So just the asset that create a direct wealth effect
Okay.
in the Fed's balance sheet. So we're soon going to implement both of those, so people will be able to switch between one and the other. Because actually, even though those assets are not bought with QE, the market at the moment um, is pricing just it doesn't care. It's pricing it like they were in fact bought with QE.
Okay.
Interest rates are dropping. The dollar is
Yeah, it
pretty
doesn't make the difference yet.
weak. It doesn't make a difference yet. Yeah, exactly. So this is part of the reason why we decided to.
Could it be just one question? Could it be
Yeah.
compensate by the monetary policy in China? Could it be
Oh
strong
yeah.
enough to compensate this? And that's
Oh
why
yeah.
we think market is not seeing it yet.
Oh yeah. One thing is that one should really look at the money supply growing
Yeah.
diciamo, or mm, or dropping in each country, and see also if the central bank in that country is expanding or withdrawing liquidity. Let me highlight China here for a second, which surprisingly, if you normalize everything in US dollars, is
Yeah.
one of the biggest.
Yeah. It's pumping.
It's the biggest. So it for sure it's monetary liquidity is growing in China
Yeah.
since they went off um, the COVID restrictions that they had, and also the first chart that we are going to push in the China liquidity panel is going to be regarding their repo market and the repo liquidity injections that China does. One thing to consider is that once they inject liquidity in the repo market, they also withdraw it roughly 7 days after. they have injected it. So it's typically it's a short term it's a short term say decision that they make. But here you can also look at the assets change in regards to what their balance sheet holds. And as you can see, yeah, it's growing. You can see it here in red, and you can also see it here as an aggregate of all the four biggest central banks in the world, which are the Fed, the PBOC, the ECB, and the Bank of Japan. And yeah, the liquidity in the for the PBOC, the People's Bank of China, is growing their M2. So yeah, that is inflationary, and all this obviously it reflects into global liquidity dynamics. So that certainly has to be taken into account. Um, so yeah, I believe one thing is the data, and my personal interpretation is that I'm short-term bullish on the price action of risk. Firstly, because as I said, um, you know, even though those assets that are at the moment expanding the liquidity in the central bank um, balance sheet of the Federal Reserve are not QE, the market is pricing them as if they
QA.
were.
Okay.
And yeah, also there's growth in liquidity in other parts of the world, so you should definitely try to paste the whole picture together. uh, but yeah, in the this is the very short term. In the midterm, I have to say that there are some dynamics that in my opinion are they can be risky, they can be quite risky. For example, this banking crisis is probably gonna it's probably gonna produce a credit crunch, like where credit actually is not in the best place to begin with. So if you look at this chart, you will see that the credit cycle is already pretty low to begin with. And if you think that markets, financial markets, and banks undergoing this type of stress will probably produce less credit in the economy, mostly banks. They're surely gonna tighten credit conditions, and this is gonna impact the real
It's already
economy.
the case. It's already the case. There is, at least in Europe, I don't know that much in US, but there is less and less credit, or it's harder to get your credit and stuff like that.
Exactly, and in the U.S. it's the same because banks obviously they're not gonna go and create more loans when their balance sheet is so mismatched, and they're undergoing this type of problems. So this is to be expected, and this is gonna in the midterm is gonna probably be one of the things that are most likely to produce this so anticipated recession that everyone is concerned about, and also is going to impact the supply of money, because as we described, um, the more you borrow money from banks, the more money M2 you create into existence. So um, in terms of rate of change, this cycle is already at its lows. So I wouldn't completely rule out in the midterm a retest of the lows. But I think, as I said, in the long run, max pain is up only, because eventually, if things get dire enough, um, central banks will have to intervene.
Okay, very clear. Thank you very much. We already are at like 1 hour 15, and so yeah, we
Wow.
unfortunately we do not have time to talk about everything, and I have many questions for you. So I don't know. I have questions regarding what's happening from a geopolitical point of view between Russia and China and Saudi Arabia. Those guys accepting other currencies than dollars to
Yeah.
operate and to do trades. And yeah, I don't know. Feel free to talk on any topic you like. And yeah,
I think that in this, about that, I think that the world is really changing, and since we've seen sanctions uh, to Russia, and their assets um, have been you know what's the term in English? Um, they've been basically held from U.S. authorities um, with these sanctions. I think that the U.S. Dollar isn't necessarily gonna have its world currency status challenged very soon, because at the end of the day, there's a lot of demand for U.S. debt, while, for example, Chinese debt is not that valuable in the markets, and you can see that it doesn't have a bid at the moment. Um, but at the same time, I believe that trust in the legacy system has been once again challenged, put to the test. And this eventually, I believe, given enough time, will possibly, create the conditions to have, those questions about what is a good collateral for the economy um, answered with, instead of violence and coercion, uh, answered with technology and the expression of this kind of instruments that are trustless in nature, and in my opinion are a great type of collateral, um, because it guarantees, like, this um, um, in part, they're super parties in terms of both counterparties of a transaction, like for instance Bitcoin. um, CBDCs are probably gonna um, make their appearance once monetary inflation becomes uh, unbearable, and they're probably gonna try to fix it that way, just starting over, I guess. But if you think about the fundamentals of that, it's really just the same thing. You got debt as the collateral for basically another debt, which is you know probably not the most sustainable and smart um, type of infrastructure that you can think about for the global economy. I think that, as I said, you know, the most value in the economy should be given by cash flow, and so I really believe that index tokens, but also decentralized networks um, have have the potential to become one type of collateral assets that is that can just be valued at par with public debt. Also, when public debt will be forced to um, to basically follow the same rules as everyone else. because I really believe in a future um, with an open market of many different currencies. Uh, I don't necessarily see Bitcoin as the best type of currency. Also because I don't think it's a good currency, since its value is not stable enough. And you cannot ask, like,
Yeah.
for example,
Don't you
yeah,
think? Don't you think over time Bitcoin will be less and less volatile?
I think that will be the case when this market matures, but I think that will still be an asset. I really see the difference between like a stable coin or money as we intended today, and an asset. An asset is something that is volatile in nature, even if it's not very volatile, but it's still volatile. So
Yeah.
gold doesn't make a great currency, because if you ask, like, say, your pizza shop, or some a restaurant, to price all their food and beverages in Bitcoin, that's very hard, because what you're basically asking them is to become traders,
Yeah.
and to maybe hedge the price of the goods that they need to run their
Yeah. Yeah.
business. So and energy, and so we really need something that is stable in nature. And I guess that CBDCs and USDC and USDT are probably not the end game in this instance. Mm.
What do you
Uh,
think about LUSD? About the liquidity? What do you think about it?
I think it's a very nice model. Uh, I think the kind of money market, as liquidity is definitely one piece of what will be the definitive design that will probably produce. Um, what do you think of loan liquidation level on chain as a long term indicator? It's a great indicator. Um, you can. I'm sorry, I was distracted by this pretty
Yeah.
clever
Yeah.
question.
Answers the question of or very
Yeah,
large
it's
volume. It's a good
yeah,
question.
it's a good question, because actually on chain you can see there is um, you know credit. It's another metric that you have on chain, and as you can see, um, you know um, it follows the price of Ethereum in this case you have here. But it's kind of fascinating to see how um, you have the same dynamics that belong to TradFi and legacy finance, and you have the same dynamics working in crypto too. So slowly but surely, crypto is aligning with that. Um, and we also, in terms of market liquidity, so strictly speaking, like liquidations, open interest, funding, term structure, in terms of options, we're going to expand into all of that. And we're going to slowly add a lot more on chain
And,
stuff, because I'm so interested in that. But
and how would you interpret uh, loans liquidation on chain? Like lot of liquidation, what would this mean? And very low liquidation, what would this mean? No liquidation.
well, of course it's bearish when a lot of well once you create credit in crypto, and you have loans and TVL growing in money markets like Aave or Compound or Liquidity, as we were speaking, you have leverage building up in the
Yeah.
in the crypto ecosystem. So I think if you're a long-term investor, uh, those are the best entries that you can get when there's big liquidations. You buy the fails of very speculative investors, and yeah, I think I think it's a good thing
Yes.
for reasonable investors. Um,
Maybe some few
uh,
last questions before to end this podcast. Like, is there any crypto project you are
oh,
following, you are looking to right
oh,
now? Are you
oh,
interested in?
a lot. So this is the point where I give you the alpha. Okay.
Alpha time, guys. You're aware.
It's alpha time. So what I'm most interested right now is the option space
Yeah.
and the infrastructure space. So the most interesting projects for me at the moment on the infrastructure space is are Celestia
Okay.
and Asian Layer, which
Okay.
are okay.
You don't
And
take much risk, huh?
no, I'm not paid. What? Sorry,
No,
maybe
I was
I
saying you don't take that much risk
yeah I
with
don't.
your bet.
Yeah, I don't. And also, right now, I'm very, like I said, I'm interested in the option space, and I think
Yeah.
there's a lot of innovation happening there with
Yeah.
the AMM space. Also, I don't know if you heard about borrowing AMMs like Gamma Swap or
Yeah.
Infinity Pools.
Yeah. Gamma swap. I've looked at it. Do you know Panoptic in the option
Yeah, I
space?
do.
Yeah,
Yeah, I do.
it's quite cool. I
It's
think what they are building.
Yeah, I
Um,
believe it's amazing. I really like Infinity Pools
okay.
on that niche, and I think that we are moving towards a new type of primitive, a new type of AMM primitive that will possibly solve some of the issues um, with the liquidity needed to underwrite option selling, and at the same time, um, the leverage that is needed for tail assets in crypto
Yeah.
for perpetuals, and at the same time, solving those problems with liquidations is going to be a great thing for stable coins too,
Yeah.
uh,
So
which is I
yeah. Go ahead.
yeah, which is I believe what CRV USD and Frax V3 probably are working on at the moment. So um, I'm really hyped to see how those instruments end up being born.
Agree.
And yeah, I'm all into betting, on that type of future.
Very cool. Very cool. Thank you very much, Liscivia. It was a pleasure to have you on the podcast. Maybe if there is a one last question from the audience, we can take it. And if not, if you
Oh,
want
sure.
to say, yeah, one last thing we haven't said, and I didn't do my job on this part, is like to promote your website, which is amazing, guys.
Ah,
If you are really looking into liquidity, you should have a look. Oh, sorry. And I share also your Twitter account. And
uh,
yeah, and maybe you can tell
yeah.
us what are the next step for Liquidity Wiz and what will be the next implementation. What do you want to add?
Yeah, absolutely. We have a lot of work to do. So we are gonna implement um, the switch, like I said, in many of our models between um, the the regular asset um, the total asset of the Federal Reserve. We're gonna show both models with the BTFP assets and without the BTFP assets. Then we're gonna create the panel on China and add some charts there. And right after that, we're gonna, like I said, we're gonna expand into more on-chain stuff and market liquidity with open interest funding and transaction and all of that. So this is pretty much our roadmap at the moment.
Okay, really cool. And yeah, I'm gonna share your link in the how can I do that? I'm not good in the chat so people can copy paste it and have a look as well. I
Oh,
highly
thank you.
recommend people to have a look. And we had a question from uh, about your project all earlier. Yeah, are there also some free stuff uh, people can look it into
Improve
to
our understanding. Yeah. Well, of course, I share a lot of insight on my Twitter profile. I got, yeah. There's the liquidity whiz profile in which we share our charts, like mm, on a daily basis. We always publish something, and yeah, and people can also try the platform for free for 7 days
nice.
at the moment, and
That's
yeah.
cool. Very cool. Very cool. Well, thank you very much for your time. One last thing I need to tell you is like I never use Twitter. I hate it. But you are the only people on Twitter that I follow with the
You're
ring
talking
and
about,
yeah.
awesome, sir. That really
So
means a lot. I
so
appreciate it deeply.
keep publishing, and yeah, thank you very much
Yeah,
again. And yeah,
I will
hope
make
to see you
sure.
soon. Maybe for next banking crisis, we could invite you again. It would be my pleasure.
Okay, it's been like, yeah, likewise.
Nice. Thank you very much, guys. Thank you for listening to this podcast, and see you on Wednesday. Cheers.
Bye, everyone.